Okay. All right. Hopefully that has audio. All right. Get started. Thank you guys for being here. I hope everybody's doing well. We're cooked. We've been talking about it all morning, but yeah, we're cooked. We can start if anybody has any. I didn't really do like a market update slideshow or anything like that, but if anybody has anything they've been keeping track of, they want to shout it out, go for it.
You put it well. You put it well.
Thanks.
We're cooked.
Yeah, we're cooked.
Yeah, nothing else to say.
Yep. Okay, cool. All right, well then, today we're gonna do a little workshop on risk management. I want this to be like an open discussion. I don't want to be like it's just me up here presenting. You got questions at any time, interrupt me, ask as many questions as you want. I want you guys to ask questions and feel like you come away with a good understanding. So here's what we're going to be talking about today. Let me move this a little bit. Okay, so we're going to start with just some statistical concepts. If you've taken a stats class or if anybody's taken Finance 351 and or 355, this will be review. I apologize for that, but I just want to make sure we all go at the same pace. So we're going to talk about variance and standard deviation, what they are, why they're important. We're going to talk about covariance and correlation. And then that's going to lead us into our two actual risk management techniques, which are value at risk and the efficient frontier. And then when we get to the efficient frontier, that Excel template that I sent out, as long as you guys are up for it, we're going to walk through the construction of one together. Okay, so start with some statistical concepts. If I make a mistake, stop me. I'm not a math major. If somebody knows these concepts better than I do, please feel free to shore them up. Okay, so what variance is for any data set, in this case, it would be the returns of a stock. It's the average squared deviation from the mean. So if your stock's mean return is 10% a year, so like the S&P returns on average 10% a year, the variance of the S&P 500 or of like the SPY ETF, if you wanted to do that, would be any return that is outside of that mean 10%, a measure of how often and how strongly that happens. All right, that's fine. I don't know what that noise is, but everything seems to be working. One thing about variance is it is squared, so it's a little bit harder to interpret as far as like the measure being useful. So that's why we use standard deviation. Standard deviation is just the square root of the variance. So it's a lot easier to interpret, especially in the context of stock returns. And that's a very common measure of risk and volatility. If you have one asset, the standard deviation of your asset is how far outside of the mean you can expect it to go. So how much you could expect to gain or lose on any asset. Okay. All right, well, maybe that's what that was.
Everything's nice shutting down. Oh God.
Oh yeah. We're doing a little presentation workshop, but as long as that's cool with you guys, yeah. All good. All right. Technical difficulties, but we're good. Okay. So all right. So now that we've talked about variance and standard deviation, we're going to talk about covariance and correlation. These are important measures when we're looking at a portfolio of assets because they are measures of how these assets are related to each other. So covariance is just a measure of how two variables move together. So let's say you have SPY and GLD, and you want to look at when SPY goes up, what does GLD do? When SPY goes down, what does GLD do? That would be the covariance between those two. So easy to see why that's important and useful for portfolio management. You can track how your assets move together. In general, you want assets that are as negatively correlated as possible. because if they're really strongly correlated, one goes up, the other one goes up, that's good, but then one goes way down, the other one's going to go way down. You're essentially doubling your losses if you think about a 2-asset portfolio. Covariance, like variance, is not standardized, so it's a little bit harder to interpret. It can be any value. So that's why we turn covariance into correlation, because correlation is standardized. It always falls between a value of -1 and 1. So it's a lot easier to interpret. If you've got a covariance of 1 and a covariance of some super tiny, negative number that prints out in scientific notation, that's a little harder to interpret than just something between -1 and 1. I put the formulas in here. You don't necessarily need to write them down. You can find them anywhere online, but just as a way to explain them. So the covariance is calculated as the sum of the returns for one asset minus the mean return of that asset multiplied by the returns of another asset minus the mean return of that asset. And so the reason it's in a summation form is you got to do that for every return in your time horizon. So if you're looking at a year of daily returns, 365 daily returns, that's how you get your numerator. And then n-1, since we're using I believe that's because we're using a sample. You can do n if you're using a population, or I might have those flipped, but it's okay. And then once you have your covariance, you can then go to calculate your correlation, which is just this figure here is the numerator, the covariance of x and y, divided by the standard deviation of asset x times the standard deviation of asset y. That was a lot. Does that make sense? Okay, cool. Like covariance, the lower your correlation, the more diversified you can consider your portfolio. So that's why that use case cell, you just these are useful for risk elimination. Obviously, you'll never eliminate 100% of your risk, but using these, you can eliminate some. And they can also help you to try to maximize your returns and minimize your losses. All right. Good. Any questions so far? Okay. So yeah, so before I move on, so those are the important concepts. And then we're going to be applying those concepts to value at risk in the efficient frontier. So any questions about the concepts before we move on to actual applications? Cool. Okay, so value at risk is a measure of the potential losses of a risky portfolio or asset given a specific time period and a confidence interval. So let's say, and we'll get to actual examples, but our portfolio is worth about $35,000 right now. So if we're doing a value at risk for the portfolio, we're going to say, okay, X amount, our value at risk over a trading month at a 95% confidence interval is this much money. So that's kind of the way, if you're saying it rather than seeing it written out and calculated, that's how you understand it. There are 3 methods for calculating value at risk. Historical, which just uses historical return data. You get your historical return data, you group your returns together, sort them ascending to descending, and then you take your confidence interval will tell you which return. So if you have a year of trading data, it's 252 days of data, and you're at a 95% confidence interval, then you're using your 13th worst return to calculate this figure. Does that make sense? We can talk about it more later too. And you multiply that, so that worst return in that percentile that you can expect, by the value of your portfolio to get the amount of money that's at risk. The parametric and Monte Carlo methods are very similar. The parametric is also called the variance covariance method. So one problem with the historical method is it doesn't factor in any sort of risk or volatility. The variance covariance method does. It factors in the standard deviation of your portfolio to account for some risk and handle, weird events in your historical data a little better. The Monte Carlo method is calculated very similarly, but the difference between those two, the Monte Carlo method is a simulation of a bunch of possible returns to get a bunch of possible outcomes and then calculate the most likely. That makes sense. You'll see I have graphs. You'll see. So value at risk is just, that's sort of redundant. I don't know why I said it like that, but it's a quantification of risk. If your value at risk is higher than you're comfortable with, diversification if needed. I don't know if has anybody ever seen Margin Call? Yeah.
Great movie.
Yeah. So that scene at the end when they finally figure out that the mortgage bonds, if they decrease by 25% of their value, the company's going to go broke. That's value at risk. That's not my. All right. Feeling good on that so far? Okay, so these are 3 value at risk graphs for the Chico Creek Capital portfolio. So this is the historical method. I have my actual value written down here. So this is the historical method. You can see our returns are relatively normally distributed. They're a little skewed, but that's okay. So on this calculation, our value at risk is $1,217. $1,217. So what this line represents, so this is at a 95% confidence interval. So what this line represents is that this line is the worst possible 5% of losses. Anything to the left of that occurs would be considered extreme losses outside of this model, if that makes sense.
So anything to the left of the red dotted line is less than 5% likely, or am I completely mistaken?
That's a way to think about it. Yeah. And so, but the big thing to remember is, so the value of that red line is the maximum value you could expect to lose over a time period. So in this case, 5 days. This is the parametric method. So you can see it's not much different, but our value at risk grew a little bit by actually factoring in the volatility and risk of our portfolio. This one, the value at risk shoots up to about $1,400. So I think I lied to you earlier, Danny.
You did.
A little bit more than $100 difference, but still pretty close. But so you can see you factor in your risk, that's a little bit more accurate of what could happen. Now, all this being said, we are in completely unprecedented market times, so all of this could be completely irrelevant by the end of the year. Who knows? And then this is the Monte Carlo method. Very similar value. No, I didn't. It was about $1,250. So you can see with the simulating possible returns rather than using and grouping historical returns, the distribution is a little bit more normal. So that's one potential benefit of the Monte Carlo method. If you have a portfolio that has a non-normal distribution, you could do this method and that might help. I think that was everything I had to say about value at risk. That was a lot of information. Any questions?
What is the frequency on the left? Can you remind me of that?
Yeah, so frequency on the left. So these are bins of asset returns. So it's the amount of times that an asset return was in a specific dollar value range that gets put in a bin and the bin gets sized. And so how many times that happens for that asset is the y-axis.
What's the difference between is it a parametric distribution versus just a normal distribution?
Parametric was just the method for calculating.
Okay.
But so like this, so a normal distribution, you would usually see like these center bins that are a little lower. If this was perfectly normal, it would be more like the bell curve.
Gotcha.
More shaped like this. And so why the normal distribution is important, if you guys remember from like a stats class, is it measures how far out from the mean standard deviations are. 1, 2, and 3, and then anything outside that is you're just kind of cooked. So if you have a normal distribution of returns for a portfolio and you have the standard deviation, you can see, okay, well, this is my average standard deviation for this portfolio. How much is that? Okay. Any questions on value at risk? Yes.
How long of a time frame can you accurately use value at risk, whether it's parametric or Monte Carlo? Like, could you do over 30 trading days, or is that just not really?
Yeah, absolutely.
You
So,
can spread it out.
right, okay, so are you asking like the time horizon you're calculating for, or the amount of historical data that you're using?
The first one, I want to see, yeah, let's say I want to see how much my portfolio is at risk over the next 30 trading days instead of just 5. Can you do
Yes, you can. 30, maybe not. You usually would do it like a trading week is 5 days, a trading month is 21 days. So if you wanted to see it over a month, 21 days, it's 252 trading days in a year. So if you wanted to do it over a year,
You
you
could
could do
that.
that.
Pretty accurate.
Yeah.
Okay.
Yeah, but so your value at risk figure is just going to get bigger the more time you expand. All right. This is our last part of this. So the efficient frontier. So the efficient frontier represents the optimal portfolio for a desired level of risk or a desired level of return. So you can, in calculating this efficient frontier, you can, and I'll show you guys how to do this. You can, if you're using Excel, you can tell Excel, okay, I want to minimize my risk and maximize my return, and it'll show you optimal weights. When you're constructing the efficient frontier, and particularly in the method that we're going to use, the Sharpe ratio is also calculated, which is really important. The Sharpe ratio is the measure of risk to reward in your portfolio. So how much reward you're getting for the risk you're taking on. And it can show you how much more you take on more risk, how much more return you're getting. And then at a certain point, which you'll see on the graph, you take on more risk and you get less return. So that's the point where you would start to optimize. So just a preview of how we're doing this in Excel. So you calculate the expected return of your portfolio. You calculate the standard deviation of your portfolio. Once you have that, you just let Excel cook. There's built-in programs that make it so much easier. So this is a textbook graph of the efficient frontier. So what it shows you is efficient portfolios, which is like this top part of the graph here. You're taking on more risk and you're getting more return for your risk. And it shows you inefficient portfolios. So if you, for some reason, decided to invest at point B, well, that doesn't make sense that you would invest there because you could go to point A and get more return for less risk. So it shows you points along the curve, different combinations of risk and return. And it shows you oftentimes that you can get the same or more return for less risk if you're smart about it. Okay, so that's the end of the slideshow presentation. Anybody got questions? Anything they need explained more? Cool. Okay, so let's, oh man, okay, so let's do you guys want to do the Excel walkthrough?
Yeah.
Okay.
Where is it in the Discord?
It's just in general.
In general.
So this is the point where if you want to, I would group up by sector. And do follow along with the calculations with the portfolio holdings in your sector. Up to you guys. Group up however you want. I'm the professor, I'm not gonna force you to do shit.
Do we have a second audio for us to both move together?
Okay, take your time. We're kind of blowing through this, it's only 11:30.
It's you.
And I was gonna say, I'm like, oh, we don't need so.
There's so many tariffs on Madagascar. Yeah. 80% of the units go.
Dude, that's what I was saying. Remember that joke I made earlier? Fucking vanilla extract. All their extract.
I didn't know there was such a huge.
I was like, is that like movies?
No, like two lived out. I was like, two. Yeah. Oh, yeah. Oh, yeah. You were already thinking about it like that. Oh, yeah.
Vanilla extract monthly, it's 6.29 billion by 29. We'll see about that.
Results soon.
Usually pretty good. Yeah, yeah, we're gonna do it. That's not really risky. That's not my game. I'm the liable guy.
Yeah. Yeah, shorts are, honestly, I feel like shorts are almost never good. There's just so much risk in them.
It's gambling.
Shorts are so dangerous for retail
Yeah,
investors.
exactly. I mean,
It
it's
is
only-
gambling.
Yeah, it is.
Something pretty much you gotta use as part of the level to like a bigger stretch.
Yeah, missing.
That's just. Or do you have to, what, do
Yeah, you guys let me know when you're ready to go.
Oh, I gotta talk to you. One week is like. Yeah, sorry. Not a liability. No, against this.
What do you want us to have loaded into the Excel for you? Just like
Yeah.
strictly our whatever is in our sector.
You can do whatever you want. My suggestion would be to do what's in your sector, but that's not, do, if you wanna do just like a SPY, gold and bond ETFs, you can do that. It's up to you. But we'll walk through how to get everything in here and. Alright, how are we looking? We about ready to go? Okay.
I'm just trying to get the weights loaded up because it only has a total for every weight. I'm trying to get our sector weight.
Oh, that's okay. You don't actually need this.
Oh,
Yeah.
all right,
I will explain this.
all right, then I'm good.
I think I would get started. I love that they have a objective too, so we can do student screen.
With like 4 days.
Could you check down there and see? By the way, this is open house.
No,
Wait,
wait,
we have to say,
that's mine, that's how I understood from Dick.
That one.
Yeah. Yeah. There's a good chance it's all gone and stuff.
No, this shit dies like in an hour.
I'm happier with that, they sold the Apple ribbon, I got it.
Over like maybe.
Very.
Instead of, yeah.
Yeah, very.
Right?
Maybe like 6, 7.
Yeah, we'll play that. I saw, I was browsing Wall Street Bets the other day for the fun of it, and I saw some guy bought a massive put on SPY the day before the tariff war rolled out, and he made like 600 grand.
I feel like that was free, honestly.
Oh, probably Trump.
The Trump shadow account.
Yeah.
All right,
All good.
we're good? Okay. So the first step for this is getting your historical return data in here. So do however much you want. I would say for simplicity's sake, for this example, we can just do a year. So there's a few different ways you can do it. You can go to a website like Macro Trends and download. You'll end up downloading the entirety of the asset's historical returns, and you'll just have to figure out the time frame that you want. But an easier way to do it is in this version of Excel, there is a stock history function that'll do it for you, which is pretty awesome. All you need to do is declare your start date and your end date. So if we're doing a year, let's say our start date is April 4th. See my on the screen. April 4th, 2024. And our end date is April 4th, 2025. You can go over here. At this point, you're gonna want, yes,
Sorry, how did you get the start and end for macro trends?
are you,
Where did you get the start and end?
well, we're just doing it a year, so
Okay.
today is the 4th,
Okay,
so
just
April
the
4th,
year.
2025, yeah. And so the way we're doing it, you can use macro trends if you want. I'm just gonna show you guys how this is a way easier way to do it.
For the starting date, like, let's say if I wanted to do for the portfolio, can I do the date that we picked, that we bought the stock?
For sure.
And the end date just be like a year out, like what price target kind of, or?
You
Or just-
can't go farther than today,
Okay.
because there won't be data for it.
Right, okay,
Yeah.
right.
Okay, so once you have your start and end date, get just a list of your tickers up at the top. So I'm gonna do energy tickers. You guys do yours. So once you've got your tickers in there, you can load up this stock history function. And I hate to say that the computers in the FinTech lab run a version of Excel that doesn't have this function, which really sucks. But since we're in here, we'll use it because it's way easier. So you can go here, do your stock history function, get your ticker, get your start date, get your end date, press enter, and there you go. And so then here, I'll highlight that function. So
So.
Are you able to zoom in at all?
Yeah.
Thank you.
yeah,
There's more variables in the function, the interval, header, property one, property two. What are these?
For what we're doing today. Yeah, this is where they push out there. But just for today.
Or you put in the dates first.
Yeah, date range and then closing price. All trades.
Oh, I see, I see. And feel it's hard.
Yeah.
So what am I trying to find? Is this like all this?
So that's the closing price for each of those classes.
Mine's all over the place. Mine's.
So just to keep moving today, we're gonna do this. Just one thing to note, when you're bringing in historical data and you're using historical data, it's best practice to use the adjusted close prices. That accounts for dividends and for stock splits. So we're gonna stick with this for now for the example, but I would encourage you afterwards to go back and if you find that the adjusted close prices for your selected tickers are different, make that change and see how it changes. So yeah. Tickers here. All right, everyone just give me a thumbs up when you've got all your prices in. All right. Everybody's got prices. All right, cool. So next step is we are going to take these closing prices and we're going to transform them to what's called log normal daily returns. So we're going to use the natural log function. The reason we do that, one reason is that mathematically that has a positive lower bound at 0, which is good because it's reflective of the fact that an asset price can never be negative. So the farthest down it can go is 0. The other and to my knowledge, more important reason that we do that is it plays nice with continuous compounding. So if you think about the returns on a stock, it's compounding not once a day, not once an hour, literally every second. The price is changing continuously throughout the day. So this is the best practice way to convert these returns to a percentage. So all you're going to do for that is you're going to go, you hit equals, get your ln function. You're going to get 1 day. So you'll start with the second day in your time frame and divide it by the day before.
Second day, very cool.
And then once you do that,
I got a name.
You can just drag down to the end of your data.
Oh, you said the second day's close divided by the first day's close?
Correct. So here, I can highlight this again. So, good, yeah, so the natural log of this day's close divided by that day's close.
Was this get a percentage, just like a number that's negative?
Percentage.
You should close, formula again.
This one?
For the stock history.
Oh, yeah.
Is it okay if it's a decimal?
Sure, yeah, that's,
Both control them?
I mean, I like them as percentage for my files. If you're more comfortable with decimals,
You like a setting in Excel?
mine comes.
Oh, so you just click it and you check the. Oh, I thought you were asking if, I was asking if you were supposed to show it.
I was trying to, yeah, here's an even easier way. If you go in here. Okay, maybe it's the
percentage.
Yeah, you could, that works better in the actual app.
So the first date. And then. you have that number.
Oh, yeah, so you'll do equals LN and then divide, the fifth. Like the closing price on the fifth, by the closing price on the fifth.
Oh, can you check this out?
No, this is what I want. You ask me questions.
Some questions that you should do.
Still.
You double click it and it'll.
So, are you just trying to do PayPal?
I think it was.
Okay.
And we need to do multiple.
It's, I would do at least two. So it's brand. Okay, so here's what you do. So you do PayPal, which other one?
No, so it would be, E5, sorry, yeah,
You can stick
five by
You just at least need two.
Oh, wait, why?
So,
because you're getting the natural log of.
okay.
I guess.
So you get your start date, second day, so what you would do is you go here.
Second day
Stock history.
divided by the first.
Start history, so you
Yeah,
Oh, okay.
anything.
Not the,
Prior.
not the
And
last
hit
day.
start date.
And then that'll get you a day by day logarithm.
So that's that. So now what you want to do, I think this is the problem you run
And then
into
you'll
is
drag that
you
down
need to insert
on the
column
column.
here.
Oh,
And then those, yeah, those ones will fucking wrap out or whatever. Just because that one starts with fire.
So because it fills up two columns, you want to move this over so you can do the same thing for Mr. Card. And then that should be fine.
Okay.
And then if you want to add a third one, just make sure it's outside of where that. it is. Yeah.
I'm kind of like an idiot for dumping
So-
160 in the wallet today, fresh out of my paycheck. We'll see.
So then you'll
Can't be that bad.
Buy home.
this price.
Probably because today's
this
Monday,
And then
usually
divide it
I
by
feel like the first day of the week is a better day.
There you go.
Just
So
like
then just drag it
Yeah,
down.
something like that. So I feel like
This.
probably, short term probably has out.
Yeah, so that's up there.
Yeah, well,
Yeah. and then
Intel is
Okay,
just.
so you can delete those.
Yeah, that's definitely.
And there you go.
I mean, I've-
Alright.
Yeah, I put like all the.
Yeah,
it's for like $60 and tell them that.
One to get here for.
Almost 40% of my portfolio is gold. It's a whole big bowl.
This is like more 50%.
Yeah, well, so you're done, you're out of, so.
Isn't that down a lot?
But,
Oh,
yeah,
yeah,
you
you
can-
can-
but
oh,
my-
yeah.
So, this was somebody else.
It actually wasn't me
Yeah.
that made the original purchase
So,
on it.
I'm looking at these.
My
charts.
dad
So these
bought
were
that, like,
some dictated force.
a share. I sold off.
I mean, that's,
some
you can, that's not
back
I
in,
mean,
so.
doing this for this exercise.
Yeah, I mean, that's really.
Um, that's a way you can
Cryptocurrency gonna be here to
use
stay.
that. For sure.
I mean, yeah, for everybody.
I just thought it was like.
I think I just.
Yeah, I don't know. either. I mean, I'm just doing
Buy it.
Yeah, I think you can do futures contracts too, but I don't know. what they're saying.
I don't.
Futures are scary.
I know, right?
Not smart enough to deal with that.
I really wanna learn how to do that because it seems like.
You should talk to Jacob.
Yeah.
He's a CTA.
Oh, yeah. so
Yeah.
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 Interesting. I've got vanilla futures. Right now. Madagascar, it's crazy.
Yep. Yeah, well, wasn't it like a something percent? I think like.
It's 47%. It's ridiculous. Ice cream's gonna be really expensive.
All right. Everybody give me a thumbs up when you're ready to move on. Cool. Okay, so now that we have that, we're gonna come over here we're gonna start doing these tables. So just for organization's sake, put your tickers in. All right, so once you've got that table set up with your tickers, the first step is to calculate the annual return for your tickers. So the formula for that is going to be, it's a little convoluted, but it's also not the most convoluted one we're gonna get to, so I apologize for that. You're gonna do this EXP function, so the reason we're doing that is because we did the natural log function. So this function uses Euler's number, which you don't need to know how it works in the function. You just need to know that ln and E are related to each other, and that's why we do this. To my knowledge, I don't have a degree yet. Don't take my word as gospel. This is not financial advice. This is just the best way I know how to do it. All right, so you're gonna do that, and then you're gonna do an average of your returns. And then to annualize them, you're going to multiply them by 252, the number of trading days in a year.
How do you get all the, you drag it down? Or do you-
Give me 1 second. So you're gonna multiply by 252 to annualize it. That's the number of trading days in a year. Subtract 1 and get it as a percentage.
Sorry, there has to be a better way to drag it down.
Double shift.
I will pull down. Yeah.
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 Yeah, I should mention that if you guys, if there are ones at the bottom of your,
Can you go up so you can see the formula?
yeah, here, I'll just. Yeah, if at the bottom of your log normal returns, if you made the list too long and you're getting divide by zero errors, don't include those because it'll mess your formula up.
The old phone manager fixed that.
Dude, I don't know if this is good, but.
Pepsi's down 10%.
Yeah, I think that's actually.
Oh, so it multiplies the function by the average Euler's number, which is like 2.1, like 7, like something like that. So I don't have a great explanation, but I promise that it works.
Yeah, I just have all my values set as percents, so it's giving me percent return.
What did you say about the?
Oh,
did you get that error?
Yeah, I just like percents.
Yeah.
Well, so here, so first thing, so for this, you want to do, yeah, you have to finish that first. So you're taking an average of the percent changes,
Okay, not.
not the price changes, not the prices. Because, so the reason for that is, so one of these cells is the percent change between 2 days. If you do it with this, the values you're using are way higher than that. If you're using
That's so funny.
81
That's
as
so
an
true.
integer, you're not the change
Do
between
watch
them.
that show?
No, I haven't.
Yeah. Nice to meet you.
We don't make.
Yeah. So if you go down here and hit equals, hit ln.
Oh, these are fucking great.
Cool. So then you're just, so. Yeah. So you want to.
That one's funny.
One more down. Yeah. And then you want to divide that by the day before, so you're calculating the percent change between these prices. And then hit enter. And then you can leave it as a decimal, or if you want to format it as a percentage, you use that too. And then you can just drag it all the way down to the bottom of the rest of the price data. Then that just means you ran out of room, so you can just delete those cells. And you'll do that for the other two. Yeah, what's up?
I think this one's like you right.
Two.
This looks like this. Not that. But the percentage.
Oh.
Oh, it's on the date.
Yeah, they say wrong call. That's okay.
Is that right? The NVIDIA and AMD design the semiconductors and then TSMC produces it? Or do I have the? Yeah, so I'm like, that's a.
Isn't it like TSMC has the plant?
Yes.
Yeah,
in
they have
yeah.
the foundry in Taiwan.
Yeah.
And it's like it's the only one in the world that has whatever
Yeah.
super advanced tech that they have,
Do they design?
which is why it's such a big deal that there's
Yeah,
tariffs on
exactly.
Taiwan now.
Yeah,
They also.
they're building, you know if the new stuff they're building in the
Design
States is gonna have that capacity or?
I don't.
Yeah.
What's the future on?
Yeah.
Yeah, the only thing I know about that is that the TSMC plant in Arizona has reserved 50% of their production capacity for Qualcomm. I just read that information. Okay, so I can go back to this if people leave, but so for those that are done with this first one, a nice little trick is to do the next two or however many you have. As long as they're in a line, as long as they're next to each other like that, you can just drag her over, or you can highlight those cells and hit Control R, and it'll autofill to the next rows.
Exactly. They probably. Yes, really defined, yeah.
Why do we use the, 252?
That's the number of trading days in a year. So
Oh,
you're
okay.
annualizing
Gotcha.
percentage gains.
They're not directly related. However,
Enhanced energy has a annual.
yeah. Yeah, you did it right, so. That's what it is. So does that mean that it's like, I wouldn't last year. We come in, project that out, say, all over this trend, if you don't know.
Even so, it's over. It's the year of energy, dude. It's the year of the Celsius.
Yeah.
Yeah, it is. It
That's
is.
not-
It is.
That's not what we're doing.
No, it's not good.
Damn, right, you got the big one? How much calories in that bitch?
You guys both need at least.
I think those ones.
we do?
Yeah.
270, holy shit, dude, fuck.
Yeah, okay, then let me say this also. You guys need at least 2 tickers for this, so if you only have 1 ticker, grab another one.
Can they be in different sectors?
Yeah, you can do whatever you want.
No, that's what it is. That's what it is. I want the $3.
He's just bugging there, you run to the world, dude, they're like, oh my.
Can you go back to the first one for us?
Yeah.
Yeah, which one do you need?
Equals ln, okay, got it.
There's a whole issue.
Is it Dockey Street? Thank you.
Calling you all set over here.
What?
You want it over here?
Yeah, no, it's good, I'm good, just waiting. Oh, I was definitely.
Yeah.
Yeah, I was.
Oh, no, you're good. So I changed to just, I realized, because I already have a completed version, so I can do steps, right?
Now it gives
Yeah.
me 27.
Yeah,
So, like, how many 27?
You didn't screw anything up. I just have more data so I can check what it's already finished.
I was just, because
Yeah,
I've never done any of
Yeah.
these things before.
Sorry, I should have told you. Yeah, no, you're good.
I'll try to go.
Do that.
This is the reason why. All years. I don't know if it's on. Ellen.
Alright, you guys good back here?
Almost.
You guys are good up here? Yep. Sorry, we're kind of slow. Want to make sure everyone's coming along.
There goes my retirement.
Alright, everyone, just give me a thumbs up when you're ready to move on to the next step. Okay, yeah, you're good.
Always the.
For the standard deviation, is it going to be the same function as above, so standard deviation instead of average?
But it's not, so yeah. So it's gonna be, so remember I was talking about earlier, that variance is the standard deviation squared.
Yeah.
So there's a variance function in Excel.
Yeah.
So what we're gonna do is we're gonna wrap the variance function in a square root function,
Oh, so.
and that's gonna just give us the standard deviation.
Super.
Very. All right. How are we looking?
Almost.
But we're right here. Oh, you know, Jack, I go with my financial advice. I'm on one.
Nope.
Put in somewhere where it's gonna do something.
Average.
I got five there. We got five. Honestly, at that point, I would almost look at that as a pretty. Might as well throw it. You can like. Never. I would start there. And then, if you feel riskier.
And so then, and then for this, you do the average.
Yeah, so-
Like a risk.
Yeah.
You can look up this video, just grab this. It can apply, yeah. Yeah.
Yeah, multiplied by square root of 52.
Right, like all the, we call it, cruise liners and stuff.
Not for your standard deviation, so.
Oh.
Another.
I'll copy this, it's fine, I can just.
Okay. We're gonna move on, but you guys aren't that far behind, so you'll be fine. Okay, everyone, I want to keep this moving. So for standard deviation, like I was saying earlier, so mathematically, the variance is the square of the standard deviation. So what we're gonna do is we're going to start a square root function. We have to take the square root of our variance. And Excel has a variance function built in. I think we have enough data to use var.p, which is a population, rather than var.s, which is a sample. And then you just take, again, your range of log normal returns. And then again, multiply by 252, number of trading days in the year to annualize, and you will get your standard deviation. Yep.
Yes, you got. Or. Donkey. The nice part about this too, now we'll have this, we can just do one. Like, it'll all be there.
You all, we also have colors because lower standard deviations.
Makes sense.
Yes, it consistently sucks.
Consistently bad, yeah. That's probably one of the issues when we do ourselves, is that it's consistently bad.
Yeah, you're missing like an extra year.
So this is how far the stock price will move from the mean in the past, like
Has moved from the mean return.
how volatile. The mean return, not from the mean stock price.
Yes.
So here's 30%.
But it is one figure of like bar. Yeah, it's all over the place.
Oh, look at, here's ET, sorry. Well, ET, this for ET, this one.
Really controversial. 30% of the cow, 37% of the side.
Yeah, so ET is 22, you see the subs.
I wanna buy a house.
Yeah, I'll buy a house and retire. I'll go to war.
Bro, I'm gonna buy a house in fucking China.
Yeah.
Battle age. Gonna buy the red book.
All right, so for the next step, this is where we're gonna start setting up for the simulation that we're gonna do, where you get all those like thousands of different possible combinations. It's really simple. You just want to do the rand function, so that's going to generate a random number in this cell. And then bear with me, we have to manipulate it a little bit. So the issue with that is that these don't sum up to 1, they sum up to more than 1. So to get weights that sum up to 1, you want to go in the cell above, take that value below, oh wait, I forgot a step, sorry. Add up the sum of these, go into the cell above, divide that by the sum value, and then you want to lock the sum value because you're just staying in that cell for the denominator. And then that will make your row of weights add up to 1.
Okay.
Yeah, I'll come around. That was fast. I'll come around and so
For some reason, mine are not dragging the right, like you did it.
all right, so what you're gonna do is you're gonna sum. That. Right.
How did it drive? I wouldn't be able to. It's not right.
If you highlight to the right and then press Control R. Your sum? Okay, so then go up here. Right, having this value. You're gonna divide it.
Oh, no, you have to do it while you have an actual function.
No, this,
So you don't have to have it in that function. But so go up to whatever R8. R8, so 1 up. Then you're gonna divide.
So you're
that
dividing
value
this
by
by
that.
sum, and that makes them add up to 1.
Oh.
Because you can't have a
And then
portfolio
instead of
that has
hitting enter,
greater than 1.
You're gonna press
Not possible.
F4. That will lock.
Okay, so
unite
that's the function is
all of those
and
places and hit enter.
So
Oh.
then you hit tab
And drag it, right?
autocomplete, and you
so
can
that's
hit
what
enter.
that's.
Yeah, so no,
And
all of
then,
those will sum up to 1.
Populate it into the next. Okay, so yeah, so now you're gonna sum all of those together, and they're gonna change as you go, that's okay, they're supposed to. Yeah, so now go up to your weight array, press equals. Go down to the value below it. Yep, and then you're gonna divide that value by the sum that you calculated. Yeah, and then just press F4 to lock that. Good, now just press enter. And then you can drag that over and those should add up to one. Yeah, there you go.
And then some.
No, you don't need, you're not, yeah. That's good, because now that row, and it'll change since it's based off the random variable, but it'll always add up to one.
Okay. Mine don't add up to 100%, I only have two.
They still should.
Thankfully.
You're welcome.
We're saying we should all back by all four.
Yeah. Okay, so you can start with your software. Press equals and then type rand or rand. So this function just generates a random integer. So you can press enter, yes. And then make a population of the other ones. And then from here, you're gonna sum over here.
But the still is very comfy. They gave me the keys to the building.
So now you're gonna use the place one. Press the red, like, you know.
They can study it.
You're gonna divide that by. And you'll walk that. Drag that over, and then it should sum.
Yeah, they're like, just let them, What's the worst?
So what this is gonna do, the reason we did it is when we get down here, we're gonna create that are gonna be based on this.
Right now, you guys, oh my god.
Insane.
One chair.
So like you can see you can press. Yes. Yeah. All right. Let's keep this moving. You guys all ready to move on?
Yep.
All right.
People get screwed like that.
Yeah.
It's true.
Okay. So our next step is going to be to calculate the expected return of the portfolio. That's an easy calculation. All you're doing is you're multiplying the annual return by the weight of the stock. So an easy way to do that is do the sum product function. Your first array is going to be your annual returns. Your second array is going to be your weights. That'll give you an expected return. And these numbers are going to change as you type because we used the random function. That's good. You want that, and you'll see why later. Like you can see, I'm just pressing F9 and they keep changing. That's good. You want that.
Formula again?
So we have here, so start a function, press equals. You're gonna take this percentage down there, divide it by the sum there, and then block line. Yeah, and then block that value with F4. And then so you drag it all throughout. Press enter if you keep working there. And then populate it over, and it should. Yeah. Sweet. So then when you do,
When I add in my extra.
yeah,
It was this one.
right, yeah, and then so, and then your expected return looks good. Okay. Yeah, absolutely.
So if you got, the RAM arrays, but they're all added up, so it's basically the same thing as the weight. The sum wrong?
No, that looks fine. So all that matters is that your weight row adds up to one. So can you just highlight the whole row?
Okay.
Not that one, just the first three.
Just the first three, okay. Oh, well, this one's, different.
Okay. Are you wanting to include that?
Yeah, sure.
Okay, so,
We're only holding one thing, that's what I was like.
Right. So you're just gonna have to redo it slightly then.
Okay. Oh, was it three max?
No.
No.
You just have to redo it so that the 4
Yeah.
random weights will sum up to 1. You have 3 sum up. to
Oh,
1.
okay.
So what you're gonna do is, do you mind if I
Yeah.
check it out? So. Okay, that's good. Okay, so yeah, so what you're gonna do is you're gonna sum these 4. And now you go up here, you'll divide that by the sum, lock it so you don't drag it. And now, all 4 add to 1.
Okay.
Yeah.
Okay, so you want to.
Yeah.
I appreciate it.
Yeah, absolutely. Yeah. Sorry.
My neighbor's PayPal seems too high still. Or maybe like that's just what they expect, but not what actually happened.
Yeah.
Because we did get like 1%.
They're,
I did change the dates, so I have the dates for PayPal. I changed from last year over to this date here.
So when I first got hired, I started about doing this, and then about one month.
It'll still, the actual division plan will still behave the same and doesn't like it. But I'm really just sit down with you later.
But
Figure out.
and then the company.
Okay, sweet.
I always thought their margin were the same.
Alright. So we're almost there, actually. This next step that we're doing is the most complicated, so bear with me. So we're gonna go down to this covariance matrix, and what you're gonna do is, so just put your tickers in and make sure that the first ticker in the row across the top is the first ticker in the column going down. You do them in the same order. So then once you get that, we're gonna go, you might have to, I apologize, I should have had you guys do this first. You might have to install an add-in for Excel, which is really easy. You just go up to the ribbon, right click, hit customize ribbon, add-ins, you go down to Excel add-ins, hit go. What you're gonna install is both the analysis toolpack and the solver add-in. We're gonna need both of those.
you need, which add-ins?
The analysis toolpack and solver.
And solver, okay.
Where do you go to add-in? So go up to anywhere in here, right click, hit customize the ribbon, go to add-ins. Go down here, go. And you want analysis toolpack and solver. Oops, okay, cool. And then so to get to those, once they're installed, you'll go up to the ribbon up top and you'll go to data. and they'll be all the way over on the right. Maybe over here. All right, so once you have that, I'm gonna zoom out a little bit just because we're a little far apart here. So you go up, you launch data analysis. You'll have an option in there that says covariance. You click that, you click OK. Your input range is going to be just this entire range with all of your change values. If you selected the first row that has your tickers in it, just check this box, labels in first row. And then you're gonna click output range. Your output range, you just need to click, if I remember correctly, and I really hope I do, you just need to click this corner right here. And then you can just press OK on that. And that'll calculate your covariances for you, which is really nifty because I didn't want to do that by hand. And then you'll just have to, so these are all the values, these blank cells are going to be values that are already in here. You just have to fill them in so the whole table is full. So just make sure that you get the right ones.
What did you use for the output range? Just where that little three?
Just this top left blank cell.
Top one.
Yeah. Yeah. Okay, cool. So you're gonna go up here to data analysis. So input range. And because I selected the tickers in well,
Because he's got
output
all of
range,
those values lined out.
it's just this.
Then. The line.
Oh, yeah, well, it's because they're the same, you see how it's, SLR on the top row is the same as the, as it was on the left, so we just copy them.
This is the actual Excel page, so I. I know that's so I'm gonna fix it on my.
Okay. Okay. Sorry. Okay, so yeah, and so did you start? Definitely triggered tickers as well. Okay. So then just check this box. That's a lot. And then your output range is going to be this blank. So press enter. The numbers should be they just got rid of the tickers.
How long ago?
So you can put those back, and then so
Or I think they told.
these are all of the values. These are the values, and you just have to figure out once you get your tickers back in. So this is like I think this one will be the same as this one, and so you'll just have to follow it. You guys doing all right with this? Nice to meet you. I would close. So did you install stuff? So you're gonna go up here to data. And then you're gonna hit that one right there,
It
yeah.
actually did some really cool. It is kind of ridiculous. I have to have a section. It's really good.
You look at this?
No, I've worked at.
There.
This-
So you're gonna get covariance. So the input range is going to
So
be
you start
all.
using your cold plunge now that it's warmer? Oh, you only do it when it's cold?
This.
And then,
Isn't it just like a fucking planter box?
Gotcha. Makes sense.
So you have to buy a bunch of this stuff.
oh, cell. Okay.
Lions Den? I'd go Lions Den. I like them more than Venmo because they have like yeah. I can get day passes to Ocean through my work and then I used to go to Lions Den. Not it.
Which one's more expensive?
In Ocean.
There we go.
And then they only.
Yeah, no, that's right.
Or like a year.
Yeah.
Okay, so just put them back, and then these are gonna be.
And they have better equipment too, especially here.
Usually make sure.
I'd say Emotions and Gym.
So like column one and column.
Everyone.
So like
And
this
mine
sticker,
says
this sticker, this value will be the same as this one.
Yeah.
So you just put that into the left and right. So this one and this one. This one. Okay, so you want those.
Also, I don't know if you're big on deadlifting, they have like a full deadlift platform with like the fucking jack for it and all this stuff. They have.
Yeah.
That's actually something, I feel like I've been like a psychological block with the sort of freedom to do that. Yeah, I do.
Dude, they're like my favorite exercise. I started getting to because I'll bring it over to like power when I did high school. I had this like class and then playing the first one first. Yeah, with Dan, this guy was the second one he builds. And like, so he knows what he's doing. You make sure that I don't kill myself. I'm trying to do that.
Yeah.
Emotion. I mean, I'm gonna lie and say for sure.
So I don't know, okay, so I had to just work with Danny for the rest of this and then we'll done because we're running out of time. We're cooking. All good, man. Yeah, absolutely. It was good to see you.
Pizza out.
All right. I promise we're almost done. All right, so this step is the most complicated and I will do my best to explain it. So standard deviation, we're going to start with a square root. Now we're going to do matrix multiplication here. We don't have to do it by hand, thank God. There's functions to do it, but just I want to make sure that I explain what's happening. So the function is m molt. You're going to do 2 of those.
What YouTube video did you fucking find?
I'll show you after. Okay, so after that, you're gonna put 2 arrays in this inside matrix multiplication function. What you're gonna do is you're going to put your weights as your first array. And you are going to select this covariance matrix as the second array. Now, what you're going to do after that is hit a comma, and you're going to put a transpose function in here. So this is the part that I want to make sure I explain. So what the transpose function does is it's going to take this row of weights and transpose it from looking like this to looking like this. So instead of 1, 2, 3, it'll be 1, 2, 3. So it'll be able to multiply with this matrix. So yeah, you're gonna transpose your weights. Multiply by 252. Make sure you close all your parentheses. And then that should work out. I hope.
Yep. Hey, why did I get two?
Is it charging right now?
No, it's. Okay.
Back and forth between that.
So I.
No, I think,
Oh.
there we go.
Okay, so.
Yeah, it wasn't in all of it.
Transpose. So what you transposed
Yeah.
was the random.
You're supposed to.
You're supposed to transpose that.
To turn it into a.
Yeah.
Oh.
There you go.
Thank you. You guys all good? It's good.
I apologize if it's taking so long, but I just want to make sure everybody understands it the best that we can. Okay. Everybody good with that?
Yeah.
Okay, so the rest of this is relatively simple and quick. Your risk-free rate, I usually like to use the 10-year treasury yield, which today is 4%. Oh, not 400, Jesus. Today is 4%. Your total weight obviously always needs to be 1, so you can just add up your row of weights. Now, you've heard me talk about it a bunch. We finally got into the Sharpe ratio. And so you'll remember that I said it's just a measure of risk to reward. So what you're going to do is you're going to start your function, put your numerator in parentheses. You are going to take your expected return and subtract the risk-free rate, because that's your excess return, which we need because that's the return you're earning for taking on risk. And then you divide that by your standard deviation to get your Sharpe ratio.
Is the standard deviation supposed to be like constantly changing?
Yes.
Okay.
Yes. Because when we do the simulation, our inputs are going to be the standard deviation of the portfolio and the return of the portfolio. So they need to be able to change 5,000 times. Gotcha. So you got it set up right so far. So. Yeah. Okay, so here's what we. So you're just, this array that you have right here is just this row, you need all. So that just needs to change to. Now it should work. Yeah. You can, I'm also happy once we're done, I'll sit down and explain some more of them to you, but YouTube, there's like, people make like spreadsheets out of functions.
Should go look something.
Yeah. If you have the opportunity to take a minis class,
Yeah.
you should do that. You should take like 301.
301, but, I mean, most of the shit was online, so.
Fair enough.
Didn't learn a lot.
Yeah, that's fair.
The one with Ken.
Yeah.
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 Okay,
Well, most of the things were just.
we're on
video.
to our last two steps. Are we ready?
Yep.
Yeah. Okay, so you're gonna come down to your table here. So I've got it, I already have the template set up with 5,000 different rows. So under portfolio standard deviation, you're gonna go up here and select that. Under portfolio return, you're gonna select your expected return from the portfolio summary. This one is just, here, I'll highlight them. That one is just that one. And that one is just that one.
And a sharp ratio of 180%.
Yes.
I think it's just because of the randomization. Pepsi could pop it off.
Yeah, give me that portfolio. That's what I want. Okay.
Can you show the formula or Sharpe ratio again?
Yeah. So it's your expected return minus the risk-free rate, because that gives you the return that you're earning for taking on risk, divided by the standard deviation of the portfolio. A practical run with this real quick, just to make sure that I remember.
It just racks out.
About time, I mean, the steps of this, then I'll send you mine with the steps. If you want. Yeah, you're good. And
I'm sorry, I just scared myself for a second. I didn't want to show you guys the wrong thing to do. Okay. So what we're gonna do here is you're gonna select, starting with the row that says simulation, select these two rows. You're gonna, if you just hit, hold Control Shift and then Control Shift and then down arrow, that'll select all 5,000 of your rows. And then go back to the data tab, click what if analysis, click data table. And then you're gonna select the column input cell. And then all you have to do is select a random blank cell. Doesn't matter which one, as long as it's blank. And then you hit OK, and your table populates.
Can you do that one more time? Sorry.
Yes, I will come over to you and help you.
I realized I put it in the wrong. Pretty quick, actually, started getting fun.
You should have 5,000.
5,000?
Yeah.
Oh,
Yeah.
yeah, that.
Yeah.
This is what I see, I mean. What do you have to select it? Is you?
So you go to data solver or the data and what if analysis.
No.
So you'd have like all 5,000 in your case, 500 of your
Okay, there you go.
inputs.
You just ran 5,000 combinations. Look at me. Good job.
What is that? Partner?
Who's in there? You can ignore that for now.
Okay.
I should have taken that out. All right.
Good enough.
What that was the first time I did it, we're about to do that step. Is the last step is you are gonna tell Excel to maximize the Sharpe ratio. And so that highlighted cell was when I did that, that was the combination in the simulation that it lined up with.
Control shift down, go to data.
All right, so then if you want to visualize this, you just keep that highlighted, go to insert, it'll load, hopefully, maybe,
And then.
or not, it might crash. That would suck. Come on.
All you did was click insert?
All I did was click.
It's because.
Uh-oh. Load, please. Oh, God.
What step did I miss?
You missed the step where my Excel's gonna crash up there. Okay, so what I was gonna have you guys do, we'll see if this works. So highlight, you can just these two rows. Oh yeah, it's crashing. So start here and then highlight all of them. We're gonna go over here to insert. And then go into charts. And then and there's your efficient frontier.
That is a frontier.
Yes, it is. What is going on with this? I just want to put a chart in. Please. All right, let me kill this.
How do I move the chart?
The cell 5,000. Aha. Okay.
Oh, it's weird.
I mean, it should just be that.
I guess it might be saying
So if you go insert tab, it recommended charts.
Yeah, you can also.
All right, last quick step and then we're done and you guys can get out of here. So the last step that we're gonna do is we're gonna use solver to tell Excel that we want to maximize this Sharpe ratio under the constraint that these weights have to add up to 1. So how we're gonna do that is we're gonna go over to data. We're going to go, did it get rid of my solver? Didn't get rid of my solver.
Non-finance computers.
Real. Okay, go over to data, click solver. You're gonna get this window. I'm just gonna hit reset. So where it says set objective, your objective cell is the cell with your Sharpe ratio. We're trying to maximize it, so we're gonna hit max. By changing the variable cells, your weight cells, subject to the constraint, you're gonna hit add. The constraint is that this cell, oh, okay, and so this is important. I beat my head against the wall trying to do this because I had forgotten to do this. This total weight cell needs to be, the function needs to be a sum of these because those are stored as random variables. It just won't work if you don't do that. So your constraint is that your cell reference, your total weight, must equal 1. And then you hit OK, and I would uncheck the make unconstrained variables non-negative, because can't give you a good explanation why, but it just messes with it. And then you hit solve, and spin. There we go. It messed up my table, which it might mess up yours, but that's okay.
Solver solution.
Did all of that, but I found it didn't have the chart.
All right, well,
Oh,
that
that's
can't be
fine.
right.
Okay. So let's see.
All we found is
Okay, so that's good. So
It's definitely can't be right.
let's see.
Oh, I got.
Oh my God.
Let's try that again.
All right, well, okay, so we're running out of time, so I'm gonna say that's a wrap on me presenting this. Not holding any of you guys here, you can go home if you want, but I'm gonna stick around and help you guys with any questions, but I'm gonna shut all this down and turn my laptop off. Thank you guys for being here. I enjoyed presenting this. That was a lot of fun. I hope you guys enjoyed it.